Delta and the bull call spread. So let's remind ourselves of what delta is first. Delta is the rate of change in the value of an option for a $1 move up or down in the underlying share price. So again, we've used our quote below for SPY. We've brought in the May 27th and the July 15th expiry. And you can see here that you've got a delta value here for the call options in the middle of your screen. So the first thing to note is that delta for call options are positive numbers. So let's look at the 207 May 27th call option, and you can see that the delta here is 0.564. What does that mean? That means that if the share price of SPY went up by $1, the value of the call option for 207 strike would go up by 56 cents. And likewise, and vice versa, if the share price falls by $1, the value of the 207 call option will go down by 56 cents. If you look at the 210 strike here, for example, you can see that the delta is different. It's 0.379. So in that situation, if the share price of SPY went up by $1, the value of the 210 call would go up by 37 cents, almost 38 cents. And then if the value of SPY dropped by $1, the value of the 210 call would almost drop by 38 cents. So remember, with a bull call spread, we've got two call options to consider. So we'll discuss that in greater detail in a moment. But just notice with delta that the further in the money you go, the larger the delta. Okay, a couple of things about delta before we get into our bull call spread example. Positive delta in an options position means that you want the share price to rise, and negative delta means that you want the share price to fall. So remember, we bought the 207 call and we've sold the 210 call with our SPY example. So let's work out the net effect of delta in the entire position. So we've bought the 207 call, we've sold the 210 call. The delta for the 207 call was 0.564 and the $210 call delta was 0.379. But remember, we sold the $210 call. So now we have these two positions, our first one being the 207 long call with a delta of 0.564. But now our 210 short call delta, the sign changes from a positive to a negative. And that's because we sold the call option. And the delta for that is minus 0.379. So when we add these two together, we get our net delta for the bull call spread. And the net delta is 0.181 or 18.1 deltas per contract. Because remember, in the options market, one contract controls 100 shares of stock. So simply multiply the net delta position by 100 to get your delta per contract. But what does a positive delta of 18.1 mean for the trade? Well, for every $1 rise in the value of the SPY share price, the total value of our bull call position will go up by $18.10. And for every $1 fall in the value of the SPY share price, the value of our bull call option spread will go down by $18.10. Another way of looking at our net delta position of 18.1, it's the very same as nearly owning 18.1 shares of SPY. So why do we say that? Remember what delta is. Delta tells you how much the position will go up or go down by for a $1 move in the underlying share price. So if the value of SPY goes up by $1 and we know that we're going to make an $18.10 profit, that means obviously that it's the equivalent of owning 18.1 shares of SPY. Now the thing about delta to note, delta changes as the share price moves. So this 18.1 delta will change as the share price moves up or down. So in order to start figuring out what our new deltas would be for a certain move in the share price, we've got to talk about gamma, and we'll do that in the following video.